Hey everybody, thanks so much for joining us today. We are so excited to go over March month market update, and we have a special guest with us today, Jeff Smith. We'll be going over a little bit more about who Jeff is shortly, but before we get started, I do want to go over our disclaimer that this presentation is for general information purposes only. We are so happy to provide this information and help you with your investments, but you are liable for any deal that you venture into. We are not giving you direct advice before going into an investment. And if you do want to seek further advice, we do have trusted advisors in-house that you can work with directly. We'll have our contact information at the end, so you can reach out to one of our fully licensed loan officers to discuss. And if you are joining us from Lifestyle, so maybe you haven't heard of Catalyst, we do want to introduce two of our speakers. Those of you that have been on, you are familiar with our CEO and founder, Wade Comeaux. Wade has over 25 years of experience in the real estate and mortgage industry. He is a licensed real estate agent and also an active investor himself. Jeff Johnson is our director of lending. Jeff also has a wealth of experience over 20 years and handles all of our lending operations in-house. And I will go ahead and pass it over to Jeff or Wade if you guys want to share a little bit about who we are.
Sure, I'll go first. Thank you, Destiny, and thank you, Jeff, for hopping on. Very excited to have you here today. Like Destiny said, if you are new and don't know who Catalyst is, we've been working with Lifestyles, I think 6 years now. So we are I think that's right. We are a hard money and permanent financing company. We are pride ourselves on being a one-stop shop for investors. We are built by real estate investors, like Destiny said. We started out doing real estate investing, so this is a space we're very comfortable with as lenders. We have done over thousands of transactions. We have a single point of contact for your loans. So once you get hooked up with us, you will get a loan officer, and that loan officer will be able to carry you all the way through from beginning, before you've done a deal, to your 10th deal, through your hard money, conventional, and possibly non-conventional loans and beyond. All of them are fully licensed. You can get pre-approved with just one credit pull typically for both hard money and long-term. And if you're looking to go buy a property and you're in a hurry, we can usually get you pre-approved within 24 to 48 hours. So just give us a call and get hooked up with an LO. And we hit the next slide.
Great.
There you go.
We offer a very wide variety of mortgage lending products. We offer hard money, which Jeff mentioned, to purchase and repair distressed real estate. We offer conventional loans, which are the best products out there. It's going to give you the best opportunity to have the lowest out-of-pocket and the highest potential cash flow. And then we also offer non-conventional buy and hold products. So this would give you the opportunity, if you do not qualify for conventional loans, to be able to buy and hold hold rental properties. Also offer cash out options on all products. So that would be your primary residence, the Lifestyles model. And we encourage people to take advantage of that dry powder that you may have saved up in your primary residence. Or if you've owned some rental properties for a while, doesn't have to be that long because the market's been super hot, you may have equity in those rental properties as well that would allow you to take that equity out and use it to purchase new properties to increase your overall income. We have non-conventional options to hold properties long-term as low as a 500 FICO, believe it or not. That is an option for somebody that may have had a little bit of a bump in the road, but they still want to get into the game. Great option for you. We offer hard money loans starting as low as 6.99 and 2 points. And then we have a very cool VIP flip program that has not only lower rates and options with only 1 point, but we can also go higher than the industry standard 70% LTV. Some borrowers can get as high as 75% LTV flips. And we also have off-market opportunities for people if they would like to talk about that. Okay, that's a good wrap up on what we offer. Slide here.
Awesome, great, thanks guys. So one more thing, if anybody has any questions, you should have a question box on your right or left-hand side of your screen, depending on your viewing device, whether it be mobile or desktop. If you have any questions, be sure to write them in the box and we'll make sure to answer them at the end. Now, I am really excited to introduce our special guest today, Jeff Smith, who is a licensed real estate agent. He's actually the manager for the Houston sector for Lifestyles Realty. He's a second generation investor and an active investor himself with over 20 years of experience. And so Jeff knows his stuff, and we are so thrilled to have him on. You also participate in a monthly webinar with Lifestyles, is that correct? Doing a market update?
I do, yeah. We'll cover some very similar topics, and we'll also. It looks like you guys have a little bit more on here too, a little bit different stuff. But I think well versed in the material we're going to discuss today.
Awesome.
Yep.
Well, Jeff, you want to tell us a little bit about? Sorry, go ahead, Wade.
Yeah, I was just going to chat with Jeff a little bit more about his background. I know we covered a few things here. You've been with Lifestyles for a long time, but one thing is not covered in your bio is that you also own a pretty significantly large rental portfolio and have done very well for you and your family with that. Tell us a little bit about the properties that you own and your overall portfolio.
Sure, we've done a lot of transactions over the 20 years that we've been doing this. Most of what we own is in the northwestern part of Harris County. We didn't really decide that up front. A lot of when we first started, we bought properties all over the region. But as our portfolio grew, the first ones we sold were the ones that were further away. We thought that was a smart thing to do early on, but it turns out that these days I hardly ever go to any of my investment properties. We've gotten to be big enough that's handled by managers and leasing people and contractors and stuff. I'm rarely ever there. So that may not have been the exact right decision, the exact right reason to sell a property, but it's just worked out that way. The portfolio has got a lot of houses because that's where we started. It's got some apartments in there as well. So we've done a lot. Like I said, there have been a lot of transactions that I've done for my family. A lot more transactions that I've helped Lifestyles members acquire and sell. All right. A lot of times, I've been doing this long enough that some of my clients have run the gamut from buying their first 10 or 12 single family properties and then trading up to apartment complexes. So I've been able to help them all the way through. You got a really cool picture of me there. That's what I look like in clothes I hardly ever wear and I don't even know fit anymore. I would like to make a clarification here. I'm with Lifestyles Realty Inc., which is a different company than Lifestyles Unlimited technically, although we do a lot of the same events together. We owned by the same person, so you can probably find Del Walmsley on a number of radio stations if you want to listen to some really detailed stuff about what we do. But Lifestyles Unlimited is an education and mentor group, which you've got down in the bottom of the slide there in yellow. Been around a long time, and if anyone's interested in learning more about membership and getting informed, reach out to Lifestyles Unlimited at lifestylesunlimited.com. With Lifestyles Realty, that's the brokerage arm of that same family of companies, and I run that brokerage in Houston. And I'm proud to say that I've been recognized as a top producer 10 times by the Houston Association of Realtors. And when I was actively practicing as a single family real estate agent exclusively, there were 25,000 agents, and the top producer status is for the top 100 or 150. That's a minuscule number compared to the overall number of people, and the people who are on my team now are much better than I ever was. We have one agent that is been in the top 10 according to the Houston Business Journal for the last 5 years. His name is Moon Kim. If you go to lifestylesrealtyinc.com, you can find out more about him. And and Jennifer McCormick's on our team too. She's been in the top 10, top 25 a number of times. You find Tracy Farquhar on that list as well. We have 4 people nominated for that list this year. So, who knows? We could exceed what we've done before on this year's list, and I'm looking forward to that, and really proud of the work that those guys do. They're, like I said, they're better at it than I ever was, and so it's fun times.
That's awesome. So I'm curious. You said you've had clients go from the beginning doing their first deals all the way up to apartments. So like, tell me your very first like 2 deals. How did that happen for you? If somebody's listening and they've never done a deal before.
Yeah. So my first property as an investor or working with a lifestyle
as an investor.
As an investor. All right. So that first deal. So you can see here that I'm a 2nd generation real estate investor. And so 2 things happened on that first deal. One was I reached out to my wife's parents. So I got into it through her parents. So 2nd generation by marriage, I guess. And he wouldn't. My father-in-law Bruce would not even communicate with me about it until I did a number of things. And the last thing on the list of things that he gave me to do was to join Lifestyles Unlimited. And once I did and became informed, he felt like at that point, then we could have an intelligent conversation, because one of the interesting things to me is that real estate agents, by and large, there was an article in the Wall Street Journal recently that there are now more agents nationally than there are properties for sale. So,
Wow.
I think you have to be discriminating when you choose a professional to work with, whether it's in your business or mine. And so, just any place to go get informed wouldn't do. He required specific information. And so I did that. And then he was willing to give me some guidance and become my mentor, which he did. And so we, that first deal was one where he put up the money and I did everything. My wife and we did everything. And then we would split whatever the profits were. When we got to the conclusion of that first deal, we had a decision to make, right? So very, very much like your borrowers have to make once they finish their rehab. Am I going to refinance this thing and keep it as a rental? Am I going to sell it and use that money to do it again? Or, I know your borrowers aren't supposed to do it, but I bet some do. They just fall in love with the place and move in, right? And so we had that decision to make, because at the time we started, we didn't own a primary residence, so all 3 options were on the table. And he threw in a 4th one, and that was he'd own or finance it for us, right? And so he'd make some interest income. Well, my wife came up with the idea, well, if he's willing to own or finance it, and he's willing to take the profits and do it again, why don't we just refinance it, pay him off, give him his portion of the profits, and then use that money to do it again? But we'll let him own or finance another house for us. So I think she swindled 2 properties out of her dad by doing that. My first transaction as a member or as a realtor, Lifestyles Realty, was interesting too, because I thought that when I had this impression of what it was, and I was way wrong. Right, I'd been an investor for 10 years, and I thought it would be an easy transition. And after my first transaction as a realtor with Lifestyles Unlimited members, that first one, my client, this was in 2010, so we were still reeling from the crash in 2008. And my client at the time made an offer on a property, full price offer, and like now, a lot of these offers are now getting, people are having to pay above list price. He made a full price offer. We ended up in a highest and best scenario where we had to go sharpen our pencil and come back with a better offer. So he did. He raised his price 10% from a full price offer. And anybody who hasn't been active for 10 years would laugh at the price, but it was a $70,000 purchase. He raised his offer to $77,000. That same property would be worth 170 today. And so he raised it 10%. Well, the listing broker called me back the next day and said, look, the other offer we had dropped out and we don't think you can appraise for what you offered. So why don't we just go ahead and go back to the $70,000 list price, right? The listing broker negotiated down.
Wow.
So that ties back to your earlier point about pick a good agent.
Yeah, it does. And so I went back to my client and told him the story, and I don't think he believed it. He just thought that I was being humble and that I was the best negotiator on the planet. And so then he says, do you think they'll mind if I change from a financed offer to all cash? Like, oh my gosh, this can't be any easier. And then I wrote 70 consecutive offers that went nowhere, right? My first impression was that this was going to be as easy as can be. And then because the first offer I ever made as a realtor went like that. And then the next 70 to 80 offers went nowhere.
That is interesting, right? Because
yep.
You had to put 70 offers in to buy your second property, I guess. I mean, that's just,
yeah. I'm smarter than that now, but I understood what we were doing wrong with those offers, and in these days we can certainly make our offers look more attractive than I did back then, but it was fun. It was fun and definitely a learning curve. Being in this business on the brokerage side is much different than when you're an investor and acting on your own behalf.
So did you immediately query that agent's listings and make offers on like 10% off?
Yeah, we did a lot of business because that brokerage was one of those at the time. There was a the REO business was really strong, right? And so that was a broker who had a contract with an asset manager for one of the bigger banks, and so we did a lot of business together.
Right.
I'm surprised they were. Oh, never mind. Sorry. Yeah. Sorry. Go ahead, Wade.
Yeah, I was just going to say I'm going to before we move into the presentation, I'm going to brag on Jeff a little bit more. He's very humble whenever he talks about the agents that work for him, but they are absolutely top producers, and his mentorship has made a big difference there, and I think those individuals' career advancement. And then I want to talk a little bit about lifestyles in general. We work with a few different networking organizations, but as far as the people who are adding homes at an incredibly rapid pace, we see lifestyles as really being a step above. They do a great job with that. We have several borrowers of ours who are lifestyles members who almost add a property a month. Sometimes they may meet their maximums at a point very quickly and get too many homes under contract. We have one person who didn't quite have the 720 FICO score and had 8 homes under contract very, very quickly. So it's really impressive what lifestyles can do. And if you really want to get into the game aggressively, this is a great team to do it with, because they will present you the properties. They have great agents. They protect your interests, put you into good deals, but can also help you accomplish your goals in as quick a time frame as you want to do it and you're capable of doing.
Yeah, one thing I would add to that is the mentor group on the Lifestyles Unlimited side, top notch as well. They're and so they, your real estate agent, obviously has an interest in you closing you closing the transaction, and so we balance that with with the mentors that have no interest at all. And so between the every one of our agents is an investor at some level, as well, and obviously the mentors in the education program are as well. And so we really think that what you get with a Lifestyles Unlimited membership through the mentoring and access to our brokerage is just unmatched.
Yes, I completely agree with that. And we're going to be sponsoring your big annual event. Destiny probably knows the dates, but we'll mention it here. It's a great place if you have not already joined Lifestyles Unlimited to get to know their organization. It's kind of their largest annual meet and greet, but also great information, tons of content. What are the exact dates on that, Destiny? You happen to have that?
It's in September. It's in September in Irving, just outside of Dallas, and it's about a 5,000 person expo.
Yeah. So anyway, if you guys have not attended that, it's definitely something worth checking out, and the Catalyst team will be there as well.
For sure.
All right. Are we ready to talk a little bit about what's going on in the market?
Let's do it.
Absolutely.
All right, big stop right here.
Yeah, so I'll talk about this a little bit, and I definitely want to get Jeff's opinion on it. So Fannie, this is actually Fannie and Freddie. The slide says Fannie, but it is both of the government-sponsored entities, which are the groups which provide a significant amount of the non-owner occupied or investment property loans. Definitely the best pricing, definitely the lowest cost structure. They have shifted their maximum amount of transactions. So we want to talk a little bit about that. The previous limit was 17%. They have put in a 7% cap. I think the running average over the last year has been about 14% of those Fannie Freddie loans being either non-owner occupied or second home. So there has been a short-term crunch there on ability to place some of those refinances. Really, they haven't changed the guidelines to speak of. They said that all the transactions had to go through a desktop underwriter, but candidly, I think almost all of them were anyway. So yeah. I don't know that that's really a profound change. So they haven't changed the box of what can be approved. They have just chosen to emphasize owner-occupied loans and that they're limiting the total amount of loans. So at the moment, all we're really seeing is a little bit of price pressure there. We've been able to navigate it thus far, but there is some price pressure. We're very confident that there's going to be other solutions here. In speaking with a lot of different people, and I've not read this in a publicly vetted source, but in speaking with people, in the industry and people that I know in the GSEs as well, it seems like this was probably the most profitable part of their portfolio. I've heard that from a lot of different people. So it wasn't that it was non-performing. I think it's maybe just a policy shift and wanting to emphasize owner occupants. But the good news about that is that whenever there's money to be made in a category that was a good, performing, there was not a lot of delinquency, not a lot of problems, someone is going to move into that space. Now, can we guarantee that's going to be the exact same price? I can't say that, and I don't know exactly where it's going to be, but I see no way that there's not groups who move in to take up that extra loan volume that's available, because it is a very profitable and solid category for investors that want to purchase these type of mortgage loans. So the good news is I think it's a temporary bump, but we wanted to talk about it because we know it's been in the news and let you know where we think it's going to go next. Jeff, do you have anything to add to that?
We got two Jeffs now. Which Jeff?
Jeff Smith. I'm sorry, Jeff Smith. Yes, a little. Sorry.
Yeah, I do. We've seen lending tighten up before, right? And one of the places that we monitor that measures the availability of mortgage credit is the Mortgage Bankers Association. And I'm not a member, but so I'm sure there's more detail that you have access to that I don't. But in some of their public reports, every month they publish what they call the Mortgage Credit Availability Index. And in February, I'm really curious, sometime in the second week of April, the March report will come out that will reflect this change. But there was a steep drop in credit availability last year when things locked down. And while it has recovered some, it did not get back up to pre-pandemic levels. The measurement currently is at the index is currently at 124, which is the lowest it's been since 2014. Well, the current 124 is what it was in 2014. It was lower a couple months ago, but in since say 2012, it's been as high as 200. So it's been fluctuating since 2011, 2012 between 100 and 200, and in February it was at 124. That just gives you an idea of where things have been moving. To give you some perspective, in 2007 or 2006, it was at 900. So at 124, it's a dwarf of what it was at 200, when just a year ago we thought that things had loosened up considerably. That was still a dwarf of what it was prior to any recession, the recession we saw in 2008. So in terms of, when it dropped from 900 to 100, what did we see? We saw hard money lending become a bigger part of the market. We saw portfolio lending become a bigger part of the market. And I think the same thing is likely to happen again, right? Dell uses the analogy of a water balloon. You squeeze it at one end, it just gets bigger at the other end. And so we'll probably see smart guys in the mortgage business create new stuff that will work just as well. And if you get a chance to go look at that, the MCAI that the Mortgage Bankers Association puts out, and you look at the expanded series, two of the conclusions I come to is that because we've had a longer run up to 200 on the index, so the lenders have been more responsible over the last decade than they were in the previous one, and so you're not going to have as much distress, right? Any problems that you might see coming because of either the pandemic or because of this rule change, the magnitude of it isn't going to be anywhere near what we saw a dozen years ago. And I don't see a whole lot of distress coming from it. I just see some hiccups and maybe redirection of where the borrowers go.
We've heard a lot of folks talk about staying on the sidelines until all these massive foreclosures hit, and I don't see a spike like that happening for a bunch of different reasons. One, like you said, it's just the credit quality to get a mortgage these days is just a lot tougher than it used to be. It's not even close. Two, the way the government is handling any of these COVID-related delinquencies, it seems that it's going to be a lot more consumer friendly than it was in the past, where it makes more sense if you were given some kind of grace. All of that grace will not be expected to be paid from like in one shot, right? It'll kind of be thrown onto the back end of the deal.
Right.
And I don't think like you said, I don't think these changes are going to create any kind of problems like delinquency wise. It's just going to be pricing pressure for investment properties in the short term, and maybe a little bit more in the long term, but I don't think it's going to be nearly as drastic as what we saw 10, 15 years ago.
Yeah.
Well, adjustments will be made, and unfortunately, it probably means that some of that additional expense is going to get passed to tenants in the form of rent increases.
Yep.
That's maybe an unintended consequence. Sometimes regulations necessarily bake all that into the thought process, but I do think that's an inevitable reality if the cost structure does stay up consistently. I really don't my perception is that I don't think it's going to go up. I think interest rates are going to increase no matter what, right? I think inflation, all of the measurements of projected inflation are high, and interest rates always increase whenever inflation goes up. That's just interest rates were their absolute highest whenever inflation was the highest in the late 70s, and other times whenever we've had higher inflation, it's kind of moved in concert with that. So I think that we are going to see upward pressure on interest rates even without this. But if there's going to be fewer non-owner occupied Fannie Freddie deals, then I think there could be some upward pricing pressure too. Good news is on the next slide, if we'll move to that, interest rates are still so historically low. Now these are owner occupied rates, right? But if we look at the history of interest rates, if I hope that the people on the call and the industry in general do not get plagued by recency bias, because yes, you could have gotten a non-owner occupied loan at a lower interest rate, 4 months ago without question. But that rate that you're getting today, which owner occupied is 3.35. We looked at some deals yesterday, 4.25 on non-owner occupied with an eighth of a point is something that we quoted a customer. Those are still so much better than what landlords were getting throughout almost every moment of the last, what's this chart show, from 1971 on. You can't see the bottom of it. I'm not sure why, but looking at another version of it, it's from 1971 until like 2012, rates were never even in this zip code where we are today. So your ability to get great cash flow through these products is simply astounding. Just not quite as good as it was 4 months ago. So,
yeah, like you said, hopefully it's not recency bias kicks in, because people they focus on what they could have had a little while ago, but in reality, I mean, Jeff, I don't know what the rate was when you got your first deal, but I'm guessing it was higher than 4.25.
It was 9.9%. And I mentioned I followed in my father-in-law's footsteps, right? And so early on, he showed me some of his records, and I was looking at, he still had some 17% interest rate loans left over from the 80s. From the early 80s. It's funny that he was an auditor for the IRS, right? And in 1981, he audited a real estate investor, and we're talking right in 81. So if you look at that, your chart, that's the peak. That's the highest part. He audited a real estate investor in 81 and became one in 82. And and he still had some of those loans left over that that he got during the 80s.
Yeah, we always like to show this chart because it's very easy to just see what rates were a year ago and be frustrated with it. Jeff made another point earlier when talking about the deal that you guys were looking at in like this is 2000. What year was that when your first deal you were looking at with the Lifestyles member?
2010.
2010, right. So we joke about this all the time. The deals that frustrate me the most are not the deals I did, it's the ones I didn't do, because now any deal that you looked at in 2010, especially 2007 or 2008, like that thing is almost unquestionably doubled by this point. So so you get the approval and you get the very low interest rates. So
when you said your offer went up 10%, I was like, whoa, that's a big number. But then when you go from 70 to 77,000, and that was 12 years ago, and like you said, it's worth 170,000 now. I was like, well, that was 7,000 well spent. The good news is that you didn't have to spend it. So this is Houston hard data for February. I'll just run through these real quick, and then we can talk about it. But single-family home sales rose 1.2% in February, 6,049 units sold, which is compared to 5,979 last February. The days on the market fell from 68 to 48. Total property sales were up 1.9 to 74. So that's including all properties. That was up almost 2%. Total dollar volume was up 17%, 2.4 billion. That number just shows with only a 1 to 2% increase, it was a 17% volume jump, which means the prices were just through the roof relative to what they were a year ago. Single family median price was up almost 13% to 275. That is a record high. Single family average price was a record high, up 16% to almost 350. Single family home month of inventory was at a historic low of 1.6, down from 3.3 before the pandemic and below the national average of 1.9. So that's very interesting. We usually are not below the national average historically, but we are now. And single family home, I'd love to get your take on this one, Jeff. Single family home rentals fell 26%, but the average rent was up almost 9% to 1924.
One thing real quick before we throw it to Jeff, I do think it's important to mention there's at least a week of originations that were not baked in here. So before you get overly concerned that home sales only rose 1.2% year over year, I think there was a week when the entire state of Texas in large part was closed down. So I'm anxious to see what the month of March shows, because I don't know, even if the market was, which it apparently is very hot because prices have gone up so much, I don't know if there's a way, if you lose an entire week or more of time to originate transactions. And then after that, so many of those, you had to do a secondary inspection to get a Fannie Freddie deal, right? You had to go back out, make sure the pipes weren't burst, all those things. So it was a really complicated month in February. But after that, I'll turn it over to Jeff.
So yeah, that was my first thought, was that if you've got I believe you have a slide in here where you're looking at changes from January to February. You're also looking at changes from February of last year to February of this year. And in cases where you're looking month over month, February is already 10% fewer days than January, and in both cases, month over month and year over year, you did lose that week. So so to still have an increase, I think is impressive. Now, with regard to that, in some of the members, some of the data that Houston Association of Realtors shares with members, they have a weekly report that they send out in addition to this monthly report. And in the weekly report for the week that ended on the 22nd, so a couple of days ago, closings were up 10% for that week. And if you look at it's just a line graph that they share. There was only 1 week this year where it was lower. So that was, guess which week, right?
Yeah.
And so it's been typically 10% more closings with and last week was 14% fewer new listings. And so I think, where are we looking at here? So if you're adding fewer new listings but still selling more properties, the number of total active listings is dropping considerably. The number of choices that buyers have are ridiculously lower. I think almost 40% fewer listings in the Houston area are active than there were last year. Pending listings, right, are also listings that are no longer active. Last week were up 19%. And these don't show up yet, but I would imagine good agents are going to convert some of these showings, right? Showings were up 63%. So some of those showings are going to convert to pending listings and ultimately closed ones. And so the prospect of additional increased sales are high. Another thing that is noteworthy here is you have a record high in both the median price and the average price. You don't get record highs in February. That's a July and August thing. That's not a winter thing. So that would show that the prospects for a strong market are high. I think, though, that the most important metric here is the months of inventory. 1.6 is really tight inventory, and you know, I'm sure it'll come up again. So I'll, you mentioned that you were interested in what I have to say about the rents. You know, 26% fewer rentals closed in February. I think a big part of that's attributable to the freeze, because even the properties that may have been available were possibly taken off the market for repairs. So you know, you lost a week just because people weren't out, and then you lost another period of time for withdrawn listings that needed repairs. But the average rent up $1,900 is significant, because the median household income of a in Harris County is low 60s, right? Across the state, mid to upper 60s. We're talking about an income of just over $5,000 a month. What can those people afford? What can a family at the median household income afford? And then you guys tell me, what would the payment be on a $276,000 purchase price, or a $350,000 purchase price, right? HUD considers affordable to be 30% of the income. So at $5,000, that's $1,500 a month. Well, the average rent's $1,900. The median rent is $1,750. Both are above what that 30% threshold is. And I don't think that median income household buying a property is likely, because you tell me, would their payment be $1,500 or less on a $300,000 purchase?
No.
I don't think so.
Taxes don't have a lot to play in it, but no, overall, no way.
Right. So I think you're going to find people are in what's called a rental trap, right? They don't have the savings for the down payment. The what was it? The median net worth of a renter nationally is $6,300. That's less than the down payment that would be required on these prices, and certainly when you add in closing costs, your typical renter cannot afford. You know, your median income household can't afford the median price property, can't even afford the median price rental. So
yeah, I think that 26% drop is what you would expect during that freeze in a normal market. I mean, we are not in a normal real estate market as far as purchasing goes. It's very hot.
Right.
And losing that much time makes sense that you're going to lose a quarter of the month's production.
Also think with the repairs and getting homes back on the market, it was much more difficult to do that, because so many people are going to prioritize their primary residence before they prioritize their rental properties, right? In general, people are throwing up a huge alarm and being relentless with those contractors if they do not have water in their house. If someone has a non-owner occupied property on the market, they're not going to be as aggressive to get that property repaired so they can put it back on the market. I think that probably played a role in this as well.
Oh, sure. It took me 5 days to get the materials I needed. I had 20 houses in my portfolio that had burst pipes, and it took me 5 days to get the materials, and then another 5 days to get the plumbing repairs done, and then additional time to go back and do drywall and the cosmetic part of that. And so yeah, it just takes time. It takes time.
No doubt. I think this, in the effort of time, I think we can skip this slide on that slide there. I think this one has some interesting stuff. Jeff mentioned the active listings being down 37%, or 38%. That's a huge number. I think the single family inventory, just to reiterate that, incredibly low, year over year, 3.3 to 1.6. Pending sales still up significantly, but we see that every month. The pending sales are never up quite as much as the sales in most months. You know, February is an anomaly because of the storm, but I really anticipate that this velocity number, even though you only have 8,000 pending sales, I think you're going to continue to see high sales numbers overall because they're just not sitting on the market that long. A lot more are closing in a quicker time frame.
I am kind of curious, so because I read this number and we've been doing this for a while now, and seemingly ever since the COVID hit, the story has been, yeah, things are hot, but there's not enough properties and sales are going to slow down eventually. They've been saying that for a year. And every time I look at the pending sales, it's significantly higher than the previous year. And so, you know, it's like, well, that's, and we're going to have a good month. And that's the case in February as well. I am curious though, because I know it's 8,200 versus 7,400, and that's more, don't get me wrong, but given the fact that we had such a slow month relative to the rest of the months, I would expect there'd be a little bit more of a glut waiting to close in March. Like, I am kind of curious if March is going to be a slowdown month relative to the rest.
You know, March could go either way if the repairs are completed or not completed. I think you know, I think that you'll know for sure in May, because you March and April could go either way depending on where those people are in repairs. There, you know, I saw on the weekly report in HAR that the number of withdrawn properties was up considerably. So I suspect they'll be back.
Yeah, that makes sense.
Those properties have to be repaired, pass inspection. Inspectors have to have time to get out there. There's a lot of moving parts to that.
Right.
Yeah. So we have a few other cities to cover, and then I do want to make sure we have time for questions. So San Antonio, I would say overall it's a similar story. Sales are not as much up as we've seen in every one of these other market reports we've done, but I think it's too short of a time frame to know if that means anything. I really don't think it does because of the same issues that they had in San Antonio that we've had everywhere else. The rent rate there is up 8%, not up as much as Houston is. That's an interesting number. I don't know if that's telling or if that's a long-term trend. I can't remember the previous months, but I think that you're going to see similar numbers in Dallas. You know, on the next slide, I think going through these overall, I think the numbers are telling, but it's very difficult to know exactly where we're at. I will say that the months of inventory numbers are still very low in comparison to previous years. And look at the average listings in Dallas, 50%. So I think a lot of the trends that we've seen are still there as far as months of inventory, active listings, prices being far up in every one of these markets. The only thing that we need to see is the lower productivity purely based, the number of transactions purely based on the snow week, or is there a little bit of a slowdown overall? And I don't think we know that yet.
Yeah, I will say, I cannot remember the exact metric. It had to do with new construction, and the only city in the major metros in Texas that did not slow down was San Antonio. Like San Antonio, they are building at a higher clip in San Antonio than the rest of the state. I know you handle Houston, Jeff. I don't know if you have any particular insight into San Antonio, or you stay out of there.
Well, I meet with my colleague weekly, you know, my counterpart in our San Antonio office, and I would say that what you see happening in Austin, because Austin's the tightest market in the state, it will at some point bleed into San Antonio. Maybe the distance between northeast San Antonio and the southern part of Austin isn't any more than what, Huntsville to Houston or Conroe to Houston. I mean, it's at some point things are going to get so tough in the Austin area that it will get to San Marcos and San Antonio, and and it's really tight in Austin.
Yeah, on slide 14, months of inventory, 0.4. You know, we think Houston's a low number at 1.7, but Austin is a 0.4, which is down 1.2 months from the previous year. Pretty incredible. It's almost hard to fathom 0.4 because 6 months is equilibrium, right? That's a balance between a seller and a buyer's market, and so far below that, it's unbelievable.
Yeah. So this is Dallas. Yeah, we can just cover that real quick. This is Dallas. The median price is up 13% year over year to 275. Active listings are down 50%. Closed numbers were down 2%. And like I said, I think that has to do with the freeze. Days on market 48, days to close 39, and months of inventory of 1.4. So it's kind of typical for what we find in the Houston market and the state of Texas. Jeff, I know earlier you said kind of what we see in Dallas is sometimes a precursor to what we see down here in Houston. Is there anything on here that kind of sticks out to you, or is just kind of the same old?
Yeah, the same stuff we were talking about before. They're dealing with. It's just that they have an economy that is, more national than we do in a lot of ways, and so their supply has been this tight for a long time. We're, being under 2 months of inventory is a relatively new thing for our area here in Houston. That's old hat for them. That's not strange to them at all.
Gotcha. Next slide.
I'm of the opinion, in the effort of time, because we want to be respectful of everybody's time. Let's go down to slide 16. I think we've kind of covered, Austin, that the inventory is super low. We know where we're at. And then I want to open it up for questions so we can still get wrapped up in the hour. I know, Jeff, you had gone over this page. I think it's the next slide.
Yeah, the next one. I read the Texas A&M report, which they do a great job of covering all the data for the entire state. And it's a long report, and these are kind of the interesting things that I plucked out of here. I'll just go through them real quick. The Texas median home price was up 13% year over year to 270, basically 278. Texas repeat sales home price index provides a better measure of changes in single family home values, was up 9.5% year over year. So those are just resales. It has nothing to do with new homes or anything like that. So if you bought a property a year ago and you sold it in Texas, odds are it went up 10%. Transactions at the bottom price, which is less than 200,000, fell to the lowest level in the series January history, with more than half occurring outside the major metros. So I brought this up because I thought it was, it makes sense. Prices going up, it's harder to find a deal under $200,000. But the part that I thought was interesting that I wanted to ask Jeff about was, because I've seen this a little bit with some of your members, more than half of them occurring outside of major metros. So talk about, if you can, do you know of maybe some of the more less populated markets, and are people kind of reaching into those areas like a Brenham or a College Station or something like that to try and find rental properties? Are you seeing that?
Well, yeah, they are. I mean, we've been having we've been experiencing an increase in activity in secondary and tertiary markets for sure. Willis, Huntsville, Livingston area, a little bit out northwest, probably not as far as College Station, although certainly Brenham, Hempstead, and nearer, and on the all the way around. I mean, we've got transactions happening in as far away as Victoria in some cases, and certainly Freeport. So we even did. I think we even had 2 closings in Beaumont in either last month or the month before. So
Yeah.
our people are buying all over the place, and they are looking in those tertiary markets, probably because you know, to accommodate people like we talked about in that median income range. A lot of times they have to commute. You know, I know that, you know, I'm from Washington, D.C., and it is not unusual for a working class person who, let's say, is a an electrician in Washington, D.C. He lives in 2 hours away in West Virginia. That kind of a thing is spreading to our area as well.
Are you seeing the deals, do the numbers looking similar, or do you get a little bit of a discount if you buy out that far out, or no?
Well, the kind of property looks different. Like some of the transactions that we've done in Huntsville and Livingston are brand new construction. You know, builders have a little bit more um, allowance, and where they can still have a decent margin when they're outside of these areas. They probably have less regulation. The lots are cheaper. Um, so we can get in at prices that work.
Gotcha. So the last couple bullet points on this slide, yeah, we've been talking about it. The Texas average days on market are at an all-time low of 43. Austin's list to sale price ratio registered above 1 for the 3rd straight month. So I thought that was interesting. You talked about earlier above market, right? So the average deal in Austin is above ask, right? So it's that's a pretty good sign right there that it is definitely a seller's market. And then the last thing, we talked about it earlier. I kind of held off on it until this slide. So Texas. So if you look, one of the slides we had earlier, it was a projected number. So Texas sales are expected to decrease 14% in February from activity in January due to the impacts of the winter storm across the state. So the experts thought when you compare January to February, you were going to see a 14% drop. These are smart people that didn't just pull that number out of thin air. In reality, Houston lost 1%. So basically the number of deals closed in January and February were identical. They were expecting a 14% drop. So that is a huge indicator that the market is very robust. And despite what everyone thought was going to be a complete nightmare scenario, it did not. They kept on chugging. Yeah. So that was very interesting. They missed by so much.
Wow. Go to the next slide. Very interested in Jeff's opinion on this. This is a slide that we've covered a few times, but it just continues to rocket up. And this is a slide showing the comparison between new home median sales price and existing home median sales price. And you can see 2011, they were a little bit closer. The gap widened in 2015 and 2017. And then it really started to tighten 2017 on. And then look at the jump here recently where that gap is almost, I mean, it's gone down to like 270 to 292 or something like that. Like it's only $20,000 difference. That's a very telling chart in my opinion. What are your opinions on that, Jeff?
So I think you one of the things you're going to find is the HAR puts out a 150 page monthly report every month, and one of the things they cover is they do a pricing cohort where they break out the prices of new homes, and you know how many of them sold at this price in this range, and what percentage of the full new home market was that, and what are the months of inventory in that pricing segment. There are a couple of things. One, there's been an uptick in some of the more affordable pricing segments. So, and we've been able at Lifestyles Realty to place some of our members into some new homes, which hasn't been the case for the last up until last summer, it hadn't been the case for the previous, I don't know, 5 or 8 years. It just wasn't. There wasn't a way for builders to make it work, or for investors to make it work with new construction. So by moving out into the tertiary markets, some of these properties are becoming more affordable. But the profile of what that property looks like is different too. You're going to see that for the first time, I think it was last year, the average size of a new home shrunk. The average size of a new home lot is shrinking as well. So what those new properties look like is changing, and I think that accounts for a lot of it. They're moving some of their developments to tertiary markets. They're building on smaller lots, and they're building smaller properties.
I think that has a lot to do with it for sure. I think another element may be there's just so much demand and so little opportunity, so many properties that these resales are just getting bid up at a very, very high number. You know, I mean, because that number's jumped from 230, it looks like in the, you know, not too long ago, up to this, you know, 270 number. And, you know, anecdotally, we hear that from quite a few people that, especially in Austin, in San Antonio, but a lot of jobs moving to the area, people have to get a home, or they're wanting to move out of an apartment complex, so they have to get a home, and there's not enough new home inventory out there. You know, we saw one report, Jeff, you can remind me, but I think until recently, like we had never built as many homes as we were building in the 50s or something crazy like that. Do you remember that one? I mean, it was
the new construction has been really slow for quite some time. It's since the 50s, I think, like, I don't know, like new build relative to the population. Like, we're not building enough new houses at all.
Yeah.
So this is kind of, this is part of that. You're seeing this because of part of that.
Yep. Yeah, that's actually a good point on the next slide. Single family housing construction permit. So up until 2005, looks like the United States and Texas were running relatively in line. Then Texas started to widen the gap a little bit, and then you can see recently that gap is widening even more. A couple different reasons for that, in my opinion. One would be just demand. You know, we've covered over the last few months the amount of people who are moving to Texas, but then secondarily, Texas does have they have fewer restrictions on new builds. So I think some of it is just regulation, that there aren't many restrictions on the ability to build new properties. So hopefully that will keep prices from growing quickly, where it starts to become more difficult for people to be able to live here affordably. And hopefully it'll keep the prices down for real estate investors too, where we can still have profitable investments. But hopefully these new construction permits that are really starting to ratchet up, it's almost as high as it was in 2007, right? We're almost back to that 2007 number, which was I think the highest it had been since the 50s, if I remember correctly on the chart. Anything to add to that, Mr. Smith?
Well, yeah, I think so. I think, you know, I mentioned a second ago that you break down the new builds by pricing segment, and it you know, and you look at what's affordable. And last month there were just over 1,200 new builds sold through Houston Realtors, and in that $100,000 to $150,000 price segment, there out of 1,200 there were 17, right?
Yeah,
and that's
not a lot of that, right?
right. There's that's the pricing segment where that median household income can afford to buy a new home, and it's also the pricing segment where a landlord can buy a new home and make it work as a rental. And out of those 17, I think 7 of them were purchased by Lifestyles members. So it's a tight market, but we do have a presence there. So it's that's helpful.
Destiny shows up. That means we're out of time, huh?
Yeah, I think we have a few questions. This last one, we've talked a lot about days on market. Newsflash, it's way lower than it was a year ago. So
Great,
let's,
Wade. Very
Captain Obvious.
awesome. So guys, thank you so much. That was so informative. We do have a couple questions, but if anybody was interested in contacting Jeff or learning more about Lifestyles Unlimited, I do have the Unlimited website up, but as he mentioned earlier, Lifestyles Realty is a separate entity. Lifestyles Realty Inc., right?
Yes, that's right.
Okay. So if you do want to contact Jeff, his email is here. Our information is over here. I did have some questions from some newer investors or those that might be venturing into the space. I answered some of those. They were general questions like what are points, and if you guys are interested in speaking with a loan officer, you can email us at info, or you can call that number right there, and one of our trusted advisors will actually go into more depth than I can. And they'll be happy to help you, walk you through each step and kind of just advise you on what the process looks like. So when you are ready, we're here for you and you build your team. I do want to point out one more thing before we jump into some of the questions. We had Anna Ortiz join us, and she's a Lifestyles Dallas Fort Worth agent. She wanted to point out that she said, although we have a vested interest to close on a property, we don't send out properties until we run the numbers on them. So she wanted to share that, and I thought it would be good information for those that aren't familiar with Lifestyles as well. So thank you, Anna, for sharing that with us.
Thanks for joining, Anna.
Yeah. Now, I did have one question up here that we passed earlier. So I think it was the last bullet point over the Houston market. And their question was, does the last bullet point mean renters are going to be more lucrative? And that last bullet point is generally where we cover what the rental rate is in Houston. And we could see that it was rising. So generally their question is, do we see that being a more lucrative space to hold, buy and hold? If you guys want to elaborate or talk any more on that.
I'll make a quick comment, and then I'll turn to, I didn't know if you were going to say anything, Jeff, but I'll pass it to you in just a second. I do think, as Jeff mentioned several times, Mr. Smith mentioned several times, that whenever home prices go up, that means that the rising tide lifts all ships, right? Because people have a comparison. If I can rent a property too close to buy a property, then I'm probably just going to buy the property. But when that gap widens, that's not as easy of a comparison, right? So I do think that we're going to see rents continue to rise if home prices continue to rise at the level that they are. So I think while last month was a larger jump in Houston than we had seen in the past, I don't know if it's going to be that big year over year every time. I do see rents continuing to rise. Jeff?
Yeah, I think that I think that the best way to build wealth is through a buy and hold strategy. Now, when I started, right, I would buy 2 or 3 to keep one. I started with not very deep pockets, right? My net worth started with a hyphen, and so it took me a strategy that I would buy 1 or 2 properties, maybe 3 to keep one. Now, having said that, I do think that the buy and hold strategy is the best path for long-term wealth building. I also think that what you're seeing is, I think what you're going to see, even if you're a fix and flip type investor or a wholesaler type investor, I think that your network needs to include landlord buyers, because the especially at that $250,000 price segment and below, because I think that your opportunities with owner occupants are going to continue to be tougher, and it just would behoove you to have a network of landlords that you can use as a way to move properties very, very quickly. And that's where I would direct you, if you're that kind of an investor, to lifestylesrealtyinc.com and network with our agents, because they already have the what I think is the best qualified network of landlord buyers in the state.
Absolutely. Destiny, you're on.
Yeah, I know. soon as I said, great, thanks. So we have quite a few more questions and we are running a little behind the time. So I apologize for anyone that is hanging on. I'm so glad that you guys are staying with us a little bit later today. One of the things that someone pointed out is, yes, this is being recorded and we do send out a link. So if you need to go, you will get a copy of this webinar. But if you have a question, make sure you stay on or at least ask your question so that we can answer. So one of the questions I have, this one's really great. This one is where is demand coming from? Is it out of state investors or people actually moving to Texas markets? And they're just trying to figure out what's causing that drive right now for us.
So there are 1,000 new Texans every day. 500 of them are from relocation. So the governor mentioned a couple of months ago that the number of companies relocating their headquarters to Texas has become what, in his quote, was a tidal wave. So there's a lot. The idea or the thinking really is that it's just going to keep going. One of the metrics I like to follow, which granted is it's not a scientific survey, but the U-Haul Migration Trends Report, and Houston has been the #1 city on that report for I think the last 11 or 12 years. And that report comes out every around Memorial Day. So we'll find out about 2020 soon, because that's going to be very interesting as well. And so, yeah, part of half of it is relocation. The other half is, natural births minus deaths and that kind of thing.
Yeah, I think the affordability has a lot to do with it as well. You're talking about people getting squeezed out, but if you look at Texas real estate or Houston real estate relative to the rest of the country, it's still a very good buy. It's a lot cheaper than buying in any of the other major metros. You go to the big cities, it's just more expensive still. So even with the prices going up, it's a good price relative to the rest of the country.
The affordability index in Houston is always one of the best in the country. I think the person also asked a question about, is it some investors? And I definitely think it is. I know we work with a lot of Lifestyles members who are outside of the state, who live in California or on the East Coast, and really investing in single family property isn't even a viable option. When your average home price is, $700,000 in some of these markets, there's no way you're going to be able to rent out property out like that. So they do invest in Houston or San Antonio or some of these other markets. Even sight unseen, the numbers are so much more attractive, and they have great mentorship from the Lifestyles group that they do that with regularity.
All right, thanks, guys. And one more thing I want to mention, we did just have 2 really big companies move to Texas in this last year, and Oracle and Tesla too, right?
That's awesome. We had Hewlett Packard move to Houston as well. So.
Hewlett Packard, okay. All right, yeah, so that's some new people coming in, that's some money. The next question that we have is, it says, market to market, is Dallas-Fort Worth's demand driving other markets up like San Antonio and Houston? Jeff Smith, I'm going to give you this question because we were just chatting about Dallas before we joined.
Yeah, so, where are we at? We're towards the end of March. So about a month ago in the Dallas Morning News, they did a report on out-of-state Dallas new homeowners new home shoppers from out of state in Dallas, and the number of them doubled. And so a lot of the people who are in Dallas looking for investment properties have decided they just can't compete there. And we do a lot of business in our Houston brokerage with Lifestyles Unlimited members that live in Dallas. So it's a real thing. I would expect that you'd see it even outside of our group, that a lot of Dallas buyers are participating in our market.
Awesome, thanks guys. So the next question that I have, this one is a little general and I think it's going to vary market to market, but The question is, what is the out-of-pocket cost for rentals on average? So I guess acquiring a rental.
Jeff probably has the best idea on that too.
Oh, I can tell you exactly what we're doing.
Hey, you want to buy a dollar?
By the dollar. So if you're asking about averages, that's a tough one because the average can be skewed. When you have even if you have a handful of nothing down type transactions, which we do, we do a handful of those, but that drives our cash on cash return up into the thousands, right? And so if you're looking at an out of pocket number that's an average with a cash on, and you're evaluating your cash on cash return, that's a little bit skewed. So I tend to go with the median, because if I were to tell you that the average is $10,000 and the average cash on cash return is 4,000%, that's not really illustrative of half, more than half the transactions. So I'll go with the median, which is exactly half. And the median cash out of pocket that we've done this year is mid 20s. So about $25,000.
That's in Houston.
Yeah, that's in Houston. Yeah, I'm not sure what it is in the other lifestyles markets, but I suspect it's probably a hair below that in San Antonio, and significantly higher than that in Dallas.
Yeah. So that 25 number is just hard money, I assume, or is that all in?
No, that's all in. Yeah, that's all in.
Okay.
I thought we had listened to a call from you previously, and it was closer to 30, but I must have misunderstood that.
Well, that number moves, right? That would have been that probably would have. We were probably on that call in
February.
Well, yeah.
Okay. Let's see. I was going to say one other thing. Oh, and correct me if I'm wrong, Jeff, but most of those ones where it is $10,000, I know in our experience, those are deals where we happen to have a good group of appraisers who are comfortable going with the highest ethical value. And it seems like that's whenever the deal's at $10,000 out of pocket. Normally, they may not be sent out in that way very regularly, but a lot of times the appraisal comes in high. That person can be out of pocket a lot less money. Would you say that's generally the time when you see that low of an out of pocket?
So I would say that if we send something out that looks like it's going to be, in the 20s or 30s even, if you get an appraisal that is even as low as 5% different than what you expected, and you're that can swing it, right, on a $200,000 appraisal. That can swing it $10,000 in this case in the right direction. Then if you then get a contractor bid that comes in 5% different on a $30,000 rehab, there's another $1,500, and you're as a buyer, your choices can affect things. I go through and look at all of the transactions that our buyers at Lifestyles close, and if you look at the difference between the cheapest hard money lender and the most expensive, there's another $2,000 swing, right? So you're as an investor, your own choices can affect your out of pocket. So if we send it out at $25,000 and you get you're working with a lender who has an appraiser who understands what you're doing, understands your rehab, and that has a fee structure that swings it in a way that is, and we evaluated the deal more conservatively than your lender plays, and you can have a $12,000-$15,000 swing in the right direction.
That's what we call a home run.
Oh yeah.
Very, very happy borrowers.
I was saying, don't get Jeff Johnson on sports. We'll be here for another hour. So we have one more question before we conclude today. This question is, as we see interest rates rising, what rate will be so high that it will make rentals not a good investment?
I think it was like 18, right, Jeff? Isn't that what your father-in-law was at?
Yeah, my father-in-law had some at above 17. I didn't see anything at 18 when, but that was 20 years ago when I was looking at his balance sheet. And, but I'll say this, that, insurance costs more on the south side of Houston than it does on the north side of Houston, right? Because you're coastal. And so what you see there is higher rental prices a lot of times, or lower sales prices. I think what you'll find is that the market will adjust. We talked about new sources of loans earlier. If this 7% thing becomes too much of a constraint, and if that's, the market will adjust. So rents will rise, unfortunately, if these costs continue to rise.
Agreed.
Awesome. Thanks, guys. Well, that concludes it for our webinar. Jeff, it was absolutely wonderful having you on here today.
Well, thanks for asking me.
Yeah, well, we have to have you again. We got a lot of comments in here and just people saying that they enjoyed the webinar as well. So thank you so much.
Thanks, Jeff.
All right. Thank you all.
All right.
All right, guys, everyone have a great day. Bye-bye.
Bye.